Hi, everyone. Thank you for joining us today. This is our last of our large case support, strategic support webinar series that we've been working on throughout the winter and spring. A lot of great topics have been covered. If you missed any, the video recordings have been out there on the YouTube page and in the Google Docs folder. This one will be focused on insurance strategies to fund retirement, which a lot of our clients are very interested in getting into their retirement. There's a lot of flexibility you can add with some of the insured retirement strategies that kind of help keep their taxes low throughout retirement or support not having clawbacks on their old age security or some other tax challenges that can happen if you're just utilizing RSPs or non-reg. The next series of webinars will be focused on the investment management part of the business, so more seg funds, GICs, financial planning, and then after that we will go into practice management and team building. Those will likely be more in the fall series, and we might touch on a few large case support topics in the fall as well. But let's get into retirement funding. So, Michael, I'll invite you to the stage and thank you for joining us.
Thank you, Corey. So I wanted to, when it comes to retirement income planning, especially with whole life cash value, there's a lot of different, obviously, things to consider and different loan strategies, kind of pros and cons of each. So I wanted to break down a few of them. The first would be accessing the cash surrender value via what's called a third party lender. So this is not the insurance company. This is someone like an Equitable Bank, a Duke, a Manulife Bank. So companies that are set up to basically specifically loan against whole life policies. Now, there are a lot of advantages to this strategy. One of them being the ability to borrow up to 100% of the cash surrender value with no additional collateral. So, depending on the IFA or on the strategy, if it is an IFA, some lenders would still require you to put up additional collateral to borrow back either against the full premium or against the cash surrender value at 100%. Certain companies like Equitable Bank and Duca do not require that. So it's a good thing to note that a lot of the time, historically speaking, clients were not as into it if they had to put up their own collateral. So this is one way to do it without. The loan proceeds are also received tax free. So because you're not liquidating the actual cash surrender value, it's not a policy loan. The entire borrowing against the CSV will be tax free. Now, with this strategy, because it's third party, there will be slightly more, what's called paperwork and application process. So there's going to be underwriting, some credit checks, some applications, things like that. So I would just kind of set the stage for your clients that it isn't just like click the button and it's done. There's a bit of a process, but there's a process with everything, so not a huge deal. One other interesting thing is that interest, of course, accrues on the outstanding loan. Repayments very flexible depending on the lender. Sometimes they can just do interest-only payments, and sometimes they can even capitalize the interest. So what capitalize the interest means is, although the interest is being owed, it's just being added to the balance outstanding, and you're not actually paying for it out of pocket. So from a cash flow perspective, you could create a situation where there is essentially like a net zero at the end of the day where the client isn't actually out of pocket. But you got to consider that capitalizing interest will significantly increase over the long term the outstanding debt, which needs to be deducted from the life insurance death benefit if they keep the loan outstanding that long, which brings me to my last point where if properly done, you would have the death benefit pay off the outstanding loan, especially if the client doesn't intend to pay off the loan during their lifetime. If they are using a loan to invest in some sort of an asset they're going to sell, they could take the proceeds, pay off the outstanding debt. But oftentimes they just want to plan it so if the death benefit's 10 million and they owe 5 million, when they die, then just 5 million is given net to their beneficiary. Now, the next way to access CSV is through a policy loan. Now, this is directly through the insurance company. So this, if you're with Sun Life, Canada Life, Equitable, whatever, this is directly, you call the insurance company to access the policy loan. And I'm going to start off with an example first. So let's say the total CSV is 200,000, but the ACB is 150,000. With a policy loan, you can loan up to the ACB tax-free, but everything over and above that will become taxable. So this individual could get a policy loan against the 150, which would be considered tax-free, but if they did the full 200, there'd be tax implications. So like dissimilar to my previous slide where you can get the full 200,000 tax-free. In this example, it depends on what the ACV is. So but this is a much quicker process. So this is kind of like the quick and fast way to get money to from your whole life policy where there's no credit checks, there's no underwriting. It's a quick turnaround. I've had it done 3 to 5 business days where my client has actually received the money. So it's a very quick process. It's like one form they fill out type thing, and not nearly as much as the previous example, but you may not be eligible for the full amount on a tax-free basis. Same thing with the interest, repayments flexible, interest only, or capitalized interest, depending on the insurance carrier. Um, you just have to find out, depending on who offers what. Now, if you don't know what the ACV is, you can call the insurance company and they'll tell you. So that's one thing to factor in as well. Just making sure you're aware of what the ACV actually is. Next is going to be partial withdrawals or surrendering your policy. So this is actually liquidating the cash surrender value. So this is if you don't want to do any loans, you just want to actually ask for the money, back essentially. So withdrawing the money from your policy, it's also known as a partial cash surrender. This differs in the sense where partial cash surrenders will reduce the final death benefit of your policy. So every dollar you take out is going to reduce the death benefit accordingly. You can also surrender the whole policy itself to receive all the cash value, but this may trigger some tax depending on, again, ACB, fair market value, how long you've had the policy, things like that. One thing to note, you cannot repay a withdrawal. So if you are cashing out from the CSV, you cannot pay it back. If you take out 100 grand, you can't put it back in. It's a permanent reduction in the policy's cash value and death benefit, but you can repay a policy loan or a third party loan. So the 2 previous slides, you have the option to repay, and then that would boost up your borrowing capability again. And this, it's kind of just like slowly chipping away at it until maybe it goes away. Now, I'll give you an example. This is for a business owner, but it will work for someone who doesn't have a corporation as well. So they have their whole life policy, they have the cash value. They can choose from one of the 3 options I just explained to access tax-free money for business investments, emergencies, cash flow, etc. So they could do the third-party lender, they could do the policy loan, or they could also just liquidate and do a partial surrender. And they could also do what we've described on a few sessions before, is using the corporately owned policy for personal use. And then now the individual shareholder has access to the line of credit they've borrowed against their corporately owned CSV, and they can use the money on a tax efficient, tax free basis personally. Now, of course, there's guarantee fees and many other tax considerations to go over. I'm not diving into that in this session, but just to give you an idea of some different ways you can use the CSV, loan styles, etc. Now, integrating this with personal retirement income. So a couple points I wanted to bring up. The first is when you're looking at your clients, like what assets do they have? Taxable, non-taxables, all their money in the RSP, and they have a huge pension and they have nothing in TFSA, nothing in non-reg, et cetera. So they're going to be killed in taxes, in the future when they start withdrawing their money, or they, for whatever reason, have some very tax efficient types of accounts. What are the future values of these accounts going to be when they convert the RSP to RIF? How much are they going to be forced to take out? What's their tax situation? And then where can you fit in tax efficient income and when? So when you're looking at these borrowing strategies, because there's interest accruing, you want to do your best to time it so they're accessing this money when they need it most. If they had, hundreds of thousands of dollars in their TFSA, maybe it doesn't make the most sense to borrow it, from year one when they're 65. But again, that's going to come down to your planning. So you just want to look at what do they have, what's it going to be worth in the future, and then where can you fit in the tax efficiency of cash surrender value. Weston, I'll pass it off to you.
Thanks, Mike. Just actually one more point that you made about when to use it as well. We've often seen clients use the cash value of the policy as a backstop for their traditional portfolio in times such as these. If they're drawing income from a more typical portfolio, as opposed to drawing it when the portfolio might be down, using a cash surrender value as collateral, policy loan, any of those ways that Mike talked about, as a way to backstop income for a period of time until the market recovers is often a nice strategy as well, and avoids a downward spiral in retirement income. I'm going to talk now about insured annuity, which is just another strategy to use some insurance to generate guaranteed income, but also maintain a legacy for the client. So let me pop up my presentation.
Weston, you're muted all of a sudden.
Let me try that again.
All right, now we can hear you.
Something a little weird there. Let's go back. Okay, going there now.
Yep.
Sorry for the technical issues, folks. So what we often see with a lot of clients, especially the older clients, is that they have a real fear about outliving their assets. That has become quite a bit forefront in the last few years, as we've seen that inflation has been pretty substantial, and the cost of living has gone up dramatically for a lot of clients. So we want to see if we can find a solution for them on that side. So they're very cautious in how they're investing. The uncertainty of interest rates have been very front and center over the last number of years as well, for a number of reasons. Trying to boost the economy, but trying to subdue inflation, and back and forth and back and forth. And that can make it challenging for clients that are using interest-bearing investments to, to have some certainty of what they can get for an income in the future. So, a lot of times they'll turn to a GIC strategy, but this often, especially in the last little while, has caused retirees to deplete their capital, simply because interest rates aren't there where they need them to be able to sustain the income that they want or need in retirement. So is there a solution to one or all of these problems? And there actually is. So, if we look at the classic GIC strategy, this is using, a non-registered assets is a common way to do this. They purchase a GIC, and that provides a specific rate of return for a set period of time, whatever that might be. That interest payment is used to support their income for that couple, and from that they pay taxes on that income derived from the GIC. It's interest income, so it's basically the least efficient form of tax income. And then from there, at death, if there is anything left in the GIC or in the non-registered, that will go through probate, and depending upon your jurisdiction, could be subject to further taxes. But at the very least, it goes into the public record of where how much money it is and where it goes and so forth through probate, which again, especially for higher net worth clients, is not always desirable. So an alternative strategy would be to use what we call an insured annuity strategy. And this provides better results both on the income side, but also on what's left from an estate planning side. So how this works. So similarly, you use non-registered capital, but instead you're buying a prescribed annuity on the client's life. And that annuity, through a life insurance company, provides a level of income. Same as the GIC, that provides some interest income that goes to the clients. And then obviously there is some taxation on that. However, because of the way many prescribed annuity is set up, the income is more tax efficient. We'll see that in a second. But the second piece of that is because we have better income, they're also able to use the excess amount of income or a portion of that to fund a life insurance policy. And with that life insurance policy, that effectively replaces the money that they use to purchase the annuity. So they purchase both income, but they've also replenished that estate value for the future. And then that money can get passed on to their beneficiaries on a tax-free basis, as we've talked about in many of our previous sessions. So when we look at this in a case study, we've got John, male, non-smoker, 70 years old, and his wife Jane, 68. Both are healthy, non-smoking. If we look at a GIC, and even right now, GIC rates to be able to get 4%. There's a few places around that'd be close to that, but that's what we were using. They had 500,000 to start. Their tax rate, highest marginal tax bracket in Alberta. So the monthly cash flow off of that was about $1,600, a little over that per month. The net is about $867 because of taxation. So your net after-tax yield is only 2% on that GIC. Now, again, unfortunately, rightly or wrongly, a lot of clients don't really look at the net after-tax yield or really quite understand that, but it is an important number because this is what they have spendable at the end of the day. When we look at the comparable from a annuity standpoint, if we use the insured annuity approach, we're still using the same 500,000. The GIC rate and the tax rate have not changed; it's the same there. But we're using a permanent insurance policy from Manulife, and we're using in this case an annuity from Equitable Life. Again, those are just the two I picked. For this particular case, it was the right fit. That might change for other clients, but those are the ones we used. And when we do a side-by-side comparison to see how these play out, on the left, you've got the GIC. On the right, you've got the insured annuity. If you start comparing them line by line, the monthly cash flow for the GIC is about 1,600, where the insured annuity is 3,100. And the reason before that is that the annuity, without getting super detailed into it, to annuities how to pay out, there's a couple components. One is interest rate does play a role, but also mortality factors play into a role in how much that they pay out. And this is guaranteed. In this case, it was a lifetime guaranteed annuity. The taxes payable on it is, again, significantly different. The GIC is $800 a month, where the insured annuity is only $22. What we do here and then, again, is, as you can see, the insurance premium, in the case of the GIC, we're not paying anything. In the case of the insured annuity, we're directing a little over $1,000 a month to an insurance policy. So the net monthly cash flow for the GIC was $867, where the insured annuity, after accounting for taxes and the cost of the insurance, was still over $2,000. So your net after-tax yield, where it was 2.8 with the GIC, is now just 4.85, a little shy of 5 in the case of the insured annuity. So when we look at that, that's 133% more income that the insured annuity provides, even with the life insurance in place. So very powerful from that standpoint. And what you would need for the GIC to match that level of income is it would have to be kicking off a little over 9% consistently for it to match the income that the insured annuity strategy provides. So really big boost to the client's after-tax income, which is really nice. But as well, you've also got the death benefit at the end of the day for the client's beneficiary. So you've replenished the money that they used to set up the insured annuity with. So when we look at these strategies kind of side by side, let's see if they match a lot of the goals that many of these clients have. In the case of the GIC strategy, is it guaranteed cash for life? No, it's not, because the GIC, again, depending upon interest rates and so forth, will go up or down depending upon the term of the GIC strategy, laddering, all that kind of stuff. In the case of the insured annuity, using a lifetime will guarantee that is the amount of income they have for the rest of their life. Is it tax efficient? The GIC is not, as we saw. The insured annuity is much more tax efficient. The insured annuity does reduce the chance of your OAS clawback because it is much more tax efficient for those particular clients. That could be of a real interest to them. The GIC strategy is not creditor protected. In the case of the insured annuity strategy, it is, as it runs through the life insurance. So that is sometimes appealing to clients as well. It's efficient in the fact that you have a predetermined transfer of assets to your client, to your heirs, right? In the GIC strategy, we really don't know what the client's going to be left with at the end of the day. With the insured annuity, we can really nail that down and have a specific number for clients to be able to provide that for them from their estate planning side. The estate transfer is free of probate in the case of the insured annuity strategy because you are using a life insurance policy. In the GIC strategy, it would be generally no. It does depend a little bit on province, but generally it would not be free of probate taxes. Inflation sensitive. Now with the GIC strategy, it is. As interest rates adjust and so forth. In the case of the insured annuity strategy, it's not. It's locked in. We know what it is. It's not going to fluctuate based on interest rates or inflation at that point. And can you access unused capital during your lifetime? In the case of the insured annuity strategy, you cannot. The money is put in place and it does guarantee income and guarantee an estate. But in most cases, there isn't a significant cash value that we build up in this strategy that you can access during a lifetime. It's about creating certainty for the clients going forward. And as we said, for a lot of those clients that are worried about potentially running out of money or things like that, this can be a nice piece of their overall retirement income strategy to ensure that they will always have money in retirement and never outlive their assets, while at the same time having money at the end of the day that will go to their beneficiaries in the future. So that covers my side of it there. Corey, if you'd like to take the reins and wrap it up.
Sounds good. Thank you, Weston. Thank you, Michael, as well for presenting. The insured annuities is a topic that used to be pretty popular, and I used to hear a lot about it kind of like 10 years ago. And it's starting to come back a little bit more. We're starting to see advisors use it a bit more, but for a while there, it sort of got a bit unpopular. You just weren't hearing about it. And part of that was the annuity rates were just so low. That just it didn't kind of have the impact that it used to. But it is back now. It is gaining steam, and I think it's a good fit for a lot of clients. And there's a lot of clients that are interested in sort of having some portion of their retirement income fixed. If they don't have a pension, they might want to kind of create their own pension. So it can definitely be a popular strategy for a portion of their wealth. Not saying you do this for every dollar, but kind of 10 to 40%, depending on the client, might make a lot of sense. Worth reviewing though. But yeah, this was the last of our large case webinar series for this winter and spring. We might do some more in the fall. But I really appreciate Wes and Michael taking the time to present for all these different topics. And anybody or any webinar that you've missed, they are available on our YouTube channel and in the Google Drive that I'm sending out to everybody. Next week, we are going to be going through a new practice management software, Propel, which is designed by a hub in partnership with another firm to help manage advisors' practices, make them more efficient with their client management and their sales process. Definitely worth attending. I think it will be an interesting webinar. And then we'll be announcing some other series of training later this year, which I hope everybody will find interesting. But really appreciate your help, Michael and Weston. You've been great. And if anybody needs help with any cases, or they have some clients they could or prospects they could use some support on, Michael, Weston, myself are always happy to help. So please reach out if you have a case. And thank you very much.